We've talked about money and the money supply in the economy and how the RBA actually manipulates the supply of money in the economy to conduct monetary policy. So what we're going to look at in this lecture is how we define money into separate categories or different monetary aggregates. So what we're going to look at is this idea of M1, M3, and finally broad money. And after we've looked at these definitions, we're going to look at the concept of liquidity and how it applies to all these three different concepts of money. Okay, so to start off with, we have M1, and M1 includes the volume of coins and notes held by the non-bank public. Non-bank public. So the non-bank public includes households and firms, which are not banks. So banks are also firms, but the non-bank public includes all firms which are not banks, plus current account deposits, these are also known as check accounts. So these current account deposits can be readily accessed by these non-bank public, and they're held with banks. And these banks are also known as ADIs, or authorized deposit taking institutions. M3 includes everything that is in M1, so the volume of coins and notes circulating in the economy, so M1 plus all other deposits by the non-bank public with banks, or financial institutions as we call them. And this would include, say for example, term deposits. So term deposits are deposits that you've put into the bank and you can only take it out after a certain number of years. So if you want to take it out now because you are running short of money, then you have to pay a fee to take it out. So this is a very good way, or a very good incentive for people to start saving money with banks, because usually term deposits pay a higher rate of interest. And finally we have N, or broad money, and this is the most comprehensive measure of money. The most comprehensive measure of money. And what this includes is M3 plus all deposits with non-bank financial institutions, so credit unions for example, NBNFs, so non-bank financial institutions, minus the holdings of, minus all deposits / holdings by the non-bank, or these non-bank financial institutions with banks. So in other words, the net difference, or the net deposit of savings in non-bank financial institutions. And why they take the net is to avoid double counting. So non-bank financial institutions are included in this idea of the non-bank public, and so some non-bank financial institutions actually hold money in check accounts and in term deposits with banks. And so because they hold term deposits with banks, this would actually be included in either M1 or M3, and therefore if we included it again in broad money, that would be double counting and be overstating the amount or the volume of money circulating in the economy. So now that we've understood or looked at the concepts of M1, M3, and broad money, we're going to look at liquidity, or the concept behind liquidity. Now, this is a fairly straightforward concept. Liquidity is defined as if assets, so if an asset is liquid, assets can be readily and easily converted into goods and services without the loss of value, or with little value lost. So take, for example, two different types of assets. We have houses, which is also an asset, and we have money. Money can be easily converted into goods and services, because if you go into a shop or a business and you ask for a specific good or service that they provide, then they will take the money and they will give you that good or service. Little to no value lost of money. However, if you have a house, you have to go through different legislative processes. You have to go through, not legislative process, but like through different different contract or legal processes, and we have to go through an agent, and we have to go through all these different types of processes before the house can actually be sold, and therefore receive money from that house and then spend it on goods and services. So a house is not a very liquid asset because it cannot be readily or easily converted into goods and services. And in most cases, sometimes you lose a little bit of value because of the commission paid to real estate agents, and because of all different types, or the cost of different types of processes and laws relating to the sale of a house. So we're going to look at liquidity as a different characteristic of M1, M3, and broad money. Now, M1 is obviously the most liquid. Is the most liquid type of money because of how coins and current account deposits can be easily turned into goods and services, as we've mentioned in that analogy before. And also M3 is less liquid because of this idea of term deposits and how we can't take the money out of accounts. So the spectrum of liquidity actually decreases as we approach, or as we move towards M3 and broad money. So this is very important to the conducting of monetary policy, because policymakers need to know which measure of money they need to control. So instead of controlling term deposits, they want to focus on the circulation of coins and notes in the economy, because that has the most direct effect on aggregate demand. So that's our lecture on monetary aggregates. To recap, there are three different monetary aggregates, ranging from most liquid, which is M1, to least liquid, which is broad money. And this is important to monetary policymakers because they want to know which type of money they need to control, and therefore which is most closely related to expenditure decisions, and therefore which affects aggregate demand.